At the end of the tax year, it's a good opportunity to look at what's happened in the last quarter as many people sit down to review their finances for the year ahead. Whilst we look at the short-term noise, we try not to let it cloud our long-term judgment, as we're always trying to minimise risk and maximising those global opportunities to help deliver you returns. As ever, our investment consultant team are here to help, and if you do need anything and have any questions, please get in touch. As we film this, Parliament is still going through the motions when it comes to the day-to-day events of Brexit. It's important for us not to focus on that and keep an eye on the long-term picture, and the same goes for your investment strategy and your portfolio. Our Brexit ISA campaign highlights, whilst times might change, a good investment strategy should be something you can stick to. We focus on this in 3 ways at Moneyfarm, with global diversification, keeping your costs down, and expert management. In December, my team and I were having conversations with clients rightly worried about how markets were performing. The expectations that the Federal Reserve in the US might move faster on monetary policy, thus choking off the growth we've seen in equities, gave markets a much more volatile period than some investors would be used to. What we said to customers was to focus on the long term. If you do have a goal only a short period away, then maybe it should be prudent to have some of your money in cash. But otherwise, I like to remind people that one of the cornerstones of investment advice is a horses for courses idea with your investments. The longer you have to invest for, the more risk you can take, and the more appropriate that certain assets, like equities, become to help you deliver long-term growth. If you had given into temptation and sold in December, you would have missed a very strong first quarter. Shifting expectations around US monetary policy were very supportive to equities in the first quarter, and the expectations around rising interest rates have fallen away somewhat. In fact, we saw one of the strongest quarters for our portfolios in history, and if you look at the S&P 500 in the US, for example, the strongest start to the year since 1998, and the strongest overall quarter since the recovery from the financial crisis in 2009. Putting these quarters together, it's important to see that they're quite rare. And this highlights the conversations that we were having with customers that sticking to your long-term strategy is important. There are going to be periods where markets go up and down more aggressively than other periods, but that's just part of the long-term journey. We typically rebalance around 3 to 5 times a year, and this is to ensure your portfolios stay aligned to their long-term objectives. The main change was to make a small reduction in our equity exposure in our high-risk portfolios, moving some of this into the bond space with the aim of overall reducing the risk and volatility in our portfolios. In our low to mid-risk portfolios, we sold some of our high yield exposure and moved that into emerging market debt, which we think offers better value and where currency should be more supportive. The investment committee met in January and decided that after the sharp sell-off in December, it probably wasn't prudent to cut risk. Happily, we've improved right there, and whilst we still think that the upside for equities may have some limits to it this year, it's important to remember that long term, this is what's going to drive your returns. Expectations of monetary policy tightening have perhaps eased over the last quarter, but this is something for us to keep an eye on as the year moves on.